Hello, everyone, and welcome. Today, we are going to dive into one of the most powerful tools for traders, the volume indicator. We are going to explore what it is, how it works, and how you can use it to make smarter trading decisions. Are you ready to boost your trading strategy? By the end of our time together, you will understand how volume plays a crucial role in market movements and how to use the volume indicator effectively in your own strategy. Before diving in, imagine standing on the trading floor with thousands of traders bustling around, each making decisions that move the market. Imagine being able to tap into that energy and understand, in real time, where the action is happening. A way to see at a glance how many traders are actively buying or selling an asset. That is exactly what a volume indicator offers. To begin, let us understand what a volume indicator is. The volume indicator is a way to see how much trading activity is happening with a stock, an asset, or any financial instrument. It is usually represented by bars beneath a price chart. Those bars are more than just simple visuals. They tell us how many shares or contracts were traded over a specific time. Have you noticed those bars when looking at a chart before? They can seem simple, but they are packed with information. In addition to understanding volume bars, it is also important to understand common chart patterns that traders use to predict price movements. Some of the key chart patterns include head and shoulders, double tops and bottoms, triangles, flags, and pennants. These patterns often give traders signals about potential reversals or continuations in price trends. Let us briefly go through each one. The head and shoulders pattern is a classic reversal pattern that typically signals a change in trend direction. It consists of three peaks, a left shoulder, a head, and a right shoulder, with the middle peak, the head, being the highest. The neckline, which connects the lows between these peaks, serves as an important support or resistance level. When you see this pattern forming along with a drop in volume, especially during the formation of the right shoulder, it can signal that a trend reversal is on the horizon. The head and shoulders pattern works in both uptrends and downtrends, indicating a reversal from bullish to bearish in an uptrend, and vice versa for an inverse head and shoulders in a downtrend. Volume is crucial during the breakout below the neckline for confirmation. Ideally, you want to see an increase in volume as the price breaks through the neckline, which adds strength to the reversal signal and increases the likelihood of the trend changing direction. Double tops and double bottoms are another set of reversal patterns. A double top forms after a price has reached a high level twice and cannot break through, indicating resistance. A double bottom is the opposite, showing that a price has tested a support level twice without breaking down. Volume is key in these patterns, as decreasing volume during the second peak or trough can suggest that the trend is losing momentum. Triangles are continuation patterns that come in three forms: ascending, descending, and symmetrical. Ascending triangles typically signal a continuation of an uptrend, with volume increasing as the price nears the breakout point. In an ascending triangle, the price forms higher lows, while the resistance level remains relatively flat, creating a tightening price range. This buildup of pressure is often followed by a breakout to the upside. Increasing volume during the breakout is crucial to confirm the strength of this move, indicating that buyers are taking control and pushing the price higher. Descending triangles, on the other hand, signal a potential continuation of a downtrend. In a descending triangle, the price forms lower highs, while the support level remains relatively flat. This pattern indicates that sellers are steadily gaining control, and the price is likely to break downward. A descending triangle breakout to the downside is ideally confirmed with a spike in volume, which shows that selling interest is strong and supports the continuation of the downtrend. Symmetrical triangles can indicate either a continuation or a reversal depending on the breakout direction. This pattern forms when the price makes lower highs and higher lows, converging into a point, creating a tightening range. The direction of the breakout is often uncertain, which makes symmetrical triangles more challenging to trade. The key is to watch for a breakout accompanied by significant volume. If the breakout occurs with low volume, it may not hold, and the price could return to the previous range. High volume, however, confirms the strength of the breakout and increases the likelihood that the price will continue in the breakout direction. In all triangle patterns, volume is a crucial factor. During the formation of the triangle, volume typically contracts as the price range narrows. This decreasing volume suggests that market participants are waiting for a significant move. When the breakout finally occurs, a sharp increase in volume helps validate the direction and strength of the breakout, providing traders with the confidence to follow the trend. Understanding how volume behaves during each stage of these patterns can help traders identify more reliable trading opportunities. Flags and pennants are short-term continuation patterns that occur after a strong price movement called the flagpole. A flag looks like a small rectangle that moves against the trend, while a pennant resembles a small symmetrical triangle. These patterns often come with a decrease in volume as the pattern forms, followed by a spike in volume during the breakout, which confirms the continuation of the previous trend. Understanding these chart patterns and how they interact with volume can significantly improve your ability to interpret market movements. When you see these patterns along with corresponding changes in volume, you can make more informed trading decisions. Keep practicing recognizing these patterns and use volume as a tool to confirm what the pattern is telling you. Imagine you are looking at a chart and you see these bars. The taller they are, the more shares were traded during that time. If the bars are shorter, fewer shares were traded. It is a simple visual that lets you see how active the market is. These bars are often color-coded, which makes things even easier. Green bars show buying activity when prices are going up, and red bars show selling activity when prices are going down. Have you noticed this color coding before? It can make understanding the market that much quicker. Now let us talk about why volume is so important for traders. Volume helps confirm the strength of price movements. If you see a price moving up and there is a lot of volume, it is a good sign that there are many traders participating and pushing that price higher. But if the price is rising and volume is low, that could be a sign that the move is weak. It might not continue for long. Think about it this way. Have you ever watched a stock go up and wondered if it was a real strong move or if it was about to fall apart? Paying attention to the volume can help you make that judgment. Chart patterns play a key role in understanding price and volume relationships. Some well-known chart patterns include the cup and handle, wedges, and rectangles, in addition to the ones we have already discussed. Each of these patterns gives traders insights into the potential direction of price based on how volume behaves during the formation. The cup and handle pattern is a bullish continuation pattern that signals the potential for a price increase. It looks like a rounded bowl followed by a smaller consolidation, which forms the handle. The volume often decreases as the cup is forming, and then picks up during the handle and subsequent breakout. The volume is a key confirmation, as increasing volume during the breakout strengthens the validity of this pattern. Wedges are another interesting chart pattern to look at. There are two types of wedges, rising and falling wedges. A rising wedge is typically considered bearish and signals a potential reversal, especially if it forms after an uptrend. Volume tends to decrease during the formation of the wedge, and a breakout to the downside is confirmed by a spike in volume. Conversely, a falling wedge is often seen as bullish and can indicate a reversal to the upside, especially when volume increases during the breakout. Rectangles are continuation patterns that show a period of consolidation where the price moves between two parallel levels of support and resistance. When the price finally breaks out of the rectangle, volume plays a critical role in confirming the strength of the breakout. High volume during the breakout signals that the move is likely to continue in the breakout direction, while low volume may indicate a false breakout or lack of conviction. Recognizing these patterns and understanding how volume interacts with them can significantly improve your ability to predict future price movements. Volume gives context to these patterns, helping you understand whether a move is backed by genuine interest or if it might be losing steam. Take the time to practice identifying these chart patterns, and always consider how volume behaves during each stage of the pattern formation. This will help you develop a deeper understanding of market behavior and improve your overall trading strategy. In the same way, when prices are going down, high volume can confirm that the downtrend is strong and that sellers are fully committed to driving prices lower. This often signals that the downtrend is likely to continue with strong momentum. However, if the price is dropping and volume is low, it could mean the market is not fully convinced of that move, and there is less enthusiasm among sellers. This lack of conviction might be a sign of a potential reversal or a weakening trend, suggesting that buyers could soon start stepping in to support the price. Patterns such as a falling wedge or a double bottom may form in these scenarios, indicating that a change in direction is on the horizon. So, whenever you are looking at a chart, always pay attention to volume. It helps tell the whole story, not just part of it, providing crucial context for interpreting price movements and anticipating possible shifts in market trends. Let us go a bit deeper and talk about how volume and price work together. If the price is going up and the volume is also increasing, it shows that there is a lot of interest and excitement about that move. Buyers are active and pushing the price higher. But if the price is rising and volume is declining, that could be a warning sign. It means that fewer people are jumping in, and the trend might be losing its strength. Have you ever seen a stock rising but felt like something was off? That is a great time to look at volume to see if it matches the price action. The same is true when prices are falling. When the price is dropping and volume is high, that tells you that there is a lot of selling pressure. It confirms the downtrend and suggests that the trend is strong and likely to continue. However, if the price is falling and volume is low, it could mean that not many people are participating in the sell-off and the downtrend is weak. This could be an early signal for a potential reversal, where the price might soon find support and begin to rise again. In such cases, it is helpful to watch for any changes in volume to confirm whether a reversal is gaining momentum. Always think about how price and volume work together. They can give you valuable clues that you might miss if you only look at price. Now let us talk about spotting trends with the volume indicator. One of the key uses of volume is to confirm trends. In an uptrend, you want to see the price going up and the volume increasing. This shows that buyers are supporting the move and it is likely to continue. If you see the price rising but volume is shrinking, it is a sign that the trend might be losing steam. It is always a good idea to stay cautious when you see that. In a downtrend, you want to see the price going down with high volume. This means there is strong selling pressure and the trend is likely to keep going. When you see high volume during a downtrend, it confirms that the sellers are fully in control and there is a consensus in the market that prices should be lower. However, if the price is falling and volume is low, it might indicate that there is not much conviction behind the selling. This lack of volume can mean that the downtrend is weak and could be running out of momentum, making a reversal more likely. In such cases, it is helpful to look for signs that buyers are stepping in, like a sudden increase in volume at a support level or a reversal pattern forming on the chart. Some important reversal patterns to watch for in a downtrend include the hammer candlestick pattern, the inverse head and shoulders, and the double bottom. The hammer pattern forms when the price drops significantly during the trading period, but recovers to close near the high, forming a small body with a long lower wick. This shows that buyers stepped in aggressively, suggesting a potential reversal, especially if accompanied by a spike in volume. The inverse head and shoulders pattern is a mirror image of the regular head and shoulders, and it often signals the end of a downtrend and the beginning of a new upward move. Volume should ideally increase on the break of the neckline to confirm the reversal. Lastly, the double bottom forms when the price reaches a low point twice, but cannot push lower, indicating strong support and a possible reversal if volume increases during the rally off the second bottom. Pay attention to the relationship between price and volume. They are like dance partners that work together to tell you what the market is really doing. When volume supports the price movement, whether upward or downward, it adds credibility to the trend. For instance, in an uptrend, rising prices accompanied by increasing volume suggest that the trend is strong and that buyers are confident. On the other hand, if volume does not support the price movement, it could be a sign of weakness. During downtrends, high volume confirms strong selling pressure, while low volume can indicate that the selling momentum is fading. Understanding this relationship, especially during downtrends, can help you spot opportunities for potential reversals or identify when the trend is likely to continue. This way, you can make more informed decisions whether to enter, hold, or exit a trade. Let us move on to breakouts. Breakouts happen when the price moves beyond an important support or resistance level. Not all breakouts are the same. When a breakout happens with high volume, it is a strong sign that the move will continue. High volume during a breakout means that there is a lot of interest from traders, adding strength to the move. However, if the volume is low during a breakout, it could indicate a false move, which might not sustain for long. These false breakouts, often called bull or bear traps, can lead traders to make poor decisions if they are not careful. There are a few key characteristics to watch when analyzing breakouts. One is to look for a surge in volume at the moment of the breakout. This volume surge is a sign that there is strong conviction behind the move, increasing the probability that the price will continue in the breakout direction. Another characteristic is to examine how the price behaves after the breakout. If the breakout occurs with high volume, but the price struggles to move further or starts to fall back to the previous support or resistance level, it may be a sign of a potential failure or a retest of the breakout level. Retests are common in breakouts. After a breakout, the price may pull back to test the newly broken support or resistance level. If this retest happens on lower volume and the price holds above the breakout level, it can provide a good entry point for traders, as it suggests the breakout is likely to hold. On the other hand, if the retest occurs with high volume and the price falls back below the breakout level, it is an indication that the breakout was false. Breakouts can be challenging because of the risk of false moves, so always keep an eye on volume as a confirmation tool. Have you ever seen a price break through a key level only to fall back again? That is why it is so important to watch the volume during a breakout. If the volume is low, the breakout might not hold, and it could be a trap. Paying attention to these signals can help you avoid getting caught in these traps and make better trading decisions. Next, let us talk about volume spikes and reversals. Sometimes you will see a big spike in volume, and this can be an important signal. Volume spikes often happen at major turning points in the market. For example, if a stock has been going up for a while and suddenly you see a large red volume bar with a price drop, it might be a sign that the trend is about to reverse. Have you ever seen this happen and wondered if it was time to make a move? Volume spikes can be a powerful signal, so it is worth paying attention to them. Volume can also be used with other tools to improve your trading. For example, you can use volume along with moving averages to get a clearer picture of what is happening. If the price moves above a moving average with high volume, it is a good sign that the breakout is strong. Conversely, if the price crosses below a moving average with high volume, it could indicate a strong bearish move. You can also use the Relative Strength Index, or RSI, along with volume to understand if an asset is overbought or oversold. If the RSI shows the asset is overbought but the volume is still rising, the uptrend might keep going for a little longer. If RSI is oversold and volume spikes, it could indicate a potential reversal as buying interest is coming in. Another useful tool to combine with volume is the Moving Average Convergence Divergence, or MACD. When MACD lines cross and there is a corresponding increase in volume, it strengthens the signal, whether bullish or bearish. Similarly, using Bollinger Bands with volume can help identify breakouts. When price breaks out of the upper or lower Bollinger Band and volume is high, it often indicates a strong move in the direction of the breakout. Using these tools together can give you a better view of the market and help you confirm signals. The more confirmation you have through multiple indicators working together, the more reliable your trading decisions can be. Another way to use volume is with support and resistance levels. When the price is approaching a key level, watching the volume can give you valuable information. If the price hits a resistance level with increasing volume, it might mean a breakout is coming. On the other hand, if the price approaches a resistance level but volume is declining, it could indicate that the move lacks the strength to break through, and a reversal might be more likely. Similarly, when the price approaches a support level, observing volume can help you determine if the support will hold. If the price reaches a support level with rising volume, it could mean that buyers are stepping in aggressively, making the support more likely to hold. However, if the volume is low as the price nears the support, it might suggest that the buying interest is not strong enough to prevent a breakdown, indicating a potential continuation of the downtrend. Another useful pattern involving support and resistance levels is volume clustering. Volume clustering occurs when significant trading activity happens near these key levels, often indicating accumulation or distribution. Accumulation occurs when traders, particularly large institutions, are buying an asset in a way that keeps the price relatively stable, suggesting that they are building positions before a potential upward movement. On the other hand, distribution is when these players are selling without causing a large price drop, implying they are offloading positions before a potential decline. If you see price consolidating near a support or resistance area with consistent volume, it could mean that large players are building positions, waiting for the right moment to push the price in their favor. Accumulation typically happens near support levels where buyers are active, while distribution often occurs near resistance levels where sellers are looking to unload. When you see volume clustering near these levels, it is essential to watch for a breakout or breakdown, as this could indicate that the accumulated positions are ready to drive the next big move. Understanding volume clustering in this way provides insight into market psychology and helps traders anticipate significant price changes. What other tools do you like to use with volume in your trading? Experimenting with different combinations, like pairing volume with trend lines, moving averages, or momentum indicators, can really help you improve your strategy and get a better sense of market sentiment. Now let us talk about some common mistakes traders make when using volume. One big mistake is ignoring price action. Volume is important, but it needs to be looked at together with price. Do not rely only on volume. Always consider what the price is doing at the same time. For example, if you see a volume spike without a significant move in price, it might be a sign of false enthusiasm rather than a genuine market shift. Another common mistake is overreacting to one-off volume spikes. Not every spike in volume means something significant. Sometimes these spikes can be triggered by news events, large institutional trades, or other temporary factors. It is better to look at the overall trend in volume rather than reacting to every small change. Consistent increases or decreases in volume over a longer period can provide more reliable signals than sudden, isolated volume spikes. This will help you avoid getting caught up in unnecessary panic and making impulsive trading decisions. Additionally, another mistake is failing to differentiate between accumulation and distribution phases. During accumulation, large players are buying up shares without causing a significant price increase, often leading to stable or slowly increasing volume. During distribution, those same players are selling off their shares, and volume might increase without a corresponding significant price change. Recognizing these phases by paying close attention to both price action and volume trends can help traders make better decisions about when to enter or exit trades. Volume also behaves differently in different market conditions. In a strong trending market, you want to see price and volume working together. In an uptrend, rising prices should be supported by rising volume. In a downtrend, falling prices should have strong volume behind them. In a range-bound market where prices are moving sideways, volume is usually lower. But if you see a sudden spike in volume during a range-bound period, it could be a signal that a breakout is coming. Have you noticed how market conditions affect your trading strategies? In summary, the volume indicator is a powerful tool that can help you confirm trends, spot potential breakouts, and understand market sentiment. By learning how volume works and using it in your strategy, you can make better, more informed decisions. Start adding the volume indicator to your charts and see how it can help you. Keep practicing and refining your approach, and you will get better with time. Thank you so much for being here today. Keep applying what you have learned, keep practicing, and keep learning. Happy trading to all of you.